Hi, I'm Gary Robinson, the co-manager of the Baillie Gifford US Growth Trust. The trust rose strongly in the year to the end of May. The net asset value was up by 16%, and the share price rose around double this amount as the discount narrowed. Unfortunately, this was behind the benchmark. The S&P 500 index rose by 25% over this period. We're disappointed to have underperformed the benchmark. In an ordinary year, a 16% net asset value return would have been a pretty good outcome. But the market's been exceptionally strong over the last year. It's also been exceptionally concentrated, with a handful of mega-cap stocks driving the return and mid and smaller companies lagging. We take comfort from the strong fundamental performance of companies in the portfolio. The aggregate revenue growth rate for the portfolio was well in excess of the market during the period. We know that over the long term, share prices follow fundamentals. This strong fundamental performance hasn't come at the expense of profitability. Indeed, we've seen a shift in emphasis in companies in the portfolio over the last year from growth alone to a more balanced approach, incorporating both growth and profitability. You can see this coming through in the numbers. At the end of Q1, over 2/3 of the portfolio had either positive free cash flow or positive earnings per share, and this compares to just under half a year ago. Indeed, we think that the companies in the portfolio are coming out of this post-COVID period a lot stronger than they went into it. Not only have they rationalized their cost bases, they've also evolved their strategies, their organizational structures, and their processes. Take Shopify as an example. Shopify came out of the pandemic with negative free cash flow margins. However, following a period of reorientation, Shopify's free cash flow margins are healthily positive again, and they may even exceed the peak level this year. Amazon's another example, which was unprofitable coming out of the pandemic in its retail business. However, it's back to being healthily profitable again. And these companies aren't just more profitable than they were. Following their reorganizations, they're a lot leaner and more agile than they were. And this is absolutely critical at this juncture because we're going through a big transition at the moment with the new technological paradigm that's come along in the form of generative AI. ChatGPT, which was launched at the end of 2022, threw generative AI into the spotlight. And we think this attention is warranted. This is one of the most important technological developments in the last century. Generative AI is already exceeding humans in certain tasks, and it's improving at a remarkable rate. We think it's got the power to transform large swathes of the economy. There are many companies in the portfolio which are looking to incorporate generative AI into their business models to improve their products or become more efficient in their cost structures. Shopify, again, has launched a new product called Sidekick, which is like an assistant for merchants that helps them to navigate the product and run their businesses better. Social media platform Meta is using AI to improve its advertising tools and to hone its content recommendation algorithms. And language learning app Duolingo has launched a new AI-powered subscription tier, which is enabling its customers to have spontaneous foreign language conversations with AI chatbots. It's not just in the application layer that we've made investments into companies that are using AI. We also invest in some of the infrastructure providers that are powering the AI revolution, such as NVIDIA, the chip provider, and Amazon through its Amazon Web Services division, which is powering some of these AI models. Portfolio turnover remains low, and it's consistent with our long-term time horizon. For a full list of transactions, please see the annual report. To give you a sense, we bought a new holding in Block. Block owns the merchant software company Square and the consumer financial services app Cash App. It's always been a great product company, but historically it's been run with a lack of financial discipline. However, this appears to be changing. Under the leadership of founder Jack Dorsey, the business has become a lot more focused and has been run to much more stringent financial targets. It now has an employee cap in place, and it's really focusing its business around just a few core tasks. As a result of this, Block has become a lot more adaptable and a lot more innovative, and ultimately we think it's going to become a lot more profitable as a business. We also added a few other names to the portfolio during the period. We bought a new holding in Insulet, the provider of pumps for diabetics, Guardant Health, provider of molecular tests for cancer, and Yeti, the consumer brand that makes durable coolers and drinks containers. To fund these purchases, we made several sales. These include Twilio, the communications provider, Zoom, the video conferencing app. We also reduced some larger holdings in the portfolio, like Shopify and Nvidia, which had exceptionally strong runs in their share prices. The market backdrop remains volatile, and the future is still very uncertain as always, but we are continuing to do what we've always done with this fund, and that's to try and identify and own the exceptional growth companies in America. One of the features that exceptional growth companies have in common is adaptability. That's because if a company is going to thrive over the long term, it needs to be able to navigate the market challenges and technological transitions that will inevitably come along the way. In this context, the transitions that we've seen at the likes of Shopify, Meta, and Block are very encouraging in this regard. They've come out of these transition periods stronger and more adaptable, which positions them well for the future. We think this characteristic of adaptability will be found in the exceptional growth companies of the future, and we believe we own many of these types of companies in the portfolio today. We also still firmly believe that America is the best place to find such exceptional growth companies. The US is the innovation capital of the world. In previous technology waves like internet and mobile, it was the US companies that drove us forward. And it's the US companies that are driving us forward this time again in new areas like artificial intelligence and space. We own many companies in the portfolio with exposure to these themes, and we believe that they have the potential to deliver exceptional returns over the long term if they execute on these opportunities.